Hello, welcome back again. Here is a last remark concerning the interest barrier rules, because I promised you somewhere in the beginning that when it comes to discussing all these measures concerning tax saving constructions, we would talk about countermeasures in German law, then about the ATAD, and then about multilateral instrument or the OECD BEPS project. And the interest barrier is, yeah, in the multilateral instrument not included because the OECD conceived the idea of such a multilateral instrument where I believe at the moment approximately 70 states agreed on a treaty which once and for no, at the same time overrides all their existing double taxation treaties due to a relatively complicated mechanism. But this MLI, the multilateral instrument, does contain nothing like an interest barrier. So this this can be dealt with relatively easily. The reason is that the multilateral instrument just changes the double taxation treaties, but how you compute the profit of your businesses, that's a question of purely domestic law, because if you have the right to tax a business or a certain part of an income, it's your own free discretion, your own free decision how you define the tax base. So a rule on how the tax base has to be defined, interest barrier, would be misplaced in anything which has to do with double taxation treaties. So at least that is the traditional view. That explains why we don't find anything on interest barrier in the multilateral instrument. With the BEPS action plans, so the project of the OECD started around 2010, 2013 or so, which aims at fighting against international tax saving models. There, indeed, interest payments were identified as a major issue, and so recommendations were made. There you find additional information in the BEPS Action Plan 4, and we are not going to go into details here. Yeah. But now, after interest barrier rules, we also should talk about another phenomenon, how one can shift money to other states. That's license payments, so royalties. And here you see again where we are after the interest barrier. Let's talk about a license barrier regime. Well, so let's first begin again with the attempt to understand how shifting taxable revenue to other states in form of license fees can work. The idea is simple. Imagine you have a company in a high-tax country, let's say Germany. 30% is probably the tax burden combined of corporation tax and trade tax. Imagine here you can earn 100 million taxable revenue, and you have now a related company, let's say a subsidiary in a foreign low-tax country. Let's imagine it's Faroestan with a local tax rate of only 1%. Now, the first thing you can do is pay a license fee for an invention where the patent right is held by our subsidiary in Faroestan. So the money leaves Germany, the German profit goes down, and the profit in Faroestan goes up. So the new tax base in Germany is only 80 million, and the new tax base at Faroestan is 20 million. That's simple. The total effect of the changes is in Germany 20 million profit vanish, so the tax liabilities go down by 6 million compared with the situation without the license payment. The change in Far-Awaystan is 1% on the 20 million, that's 200,000. And the net effect is the tax goes down in the group by 5.8 million. And if, imagine, our company in Germany needs the money back, then we could pay it back in form of a dividend, and that dividend would be very often tax-free. We ignore at this point something which will come up in a later chapter, the so-called controlled foreign companies taxation rules. But if you look at this model plain and simple as it is here, without that CFC regimes in the background, then the effect is rather simple. You have 5.8 million saved by just doing this. 8B KSTG would free the dividend from tax. So this is really a total tax saving effect. That basic idea can even work if your patent right was originally developed in the inland, because then you would have the company in Germany, it owns an intangible asset, you have that company abroad. Now the company in Germany sells the asset for the market price. You must do it for the market price because otherwise, transfer pricing rules. Otherwise, there would be a hidden profit distribution or a hidden capital contribution depending on what that company is, subsidiary or sister or parent company. Now, what happens next? Now the company abroad owns the asset, the patent right. Now the company in Germany has again high profits every year, 100 million. Now it can pay license fees to the foreign company. So the profit goes down, here it goes up. And from now on, everything works just as before. The only difference is then you have to pay once the taxes in Germany on the gain from selling the patent right or whatever it is to the company abroad. That lowers the effect a bit, but okay, in the end, there will still be a tax saving effect. Now, if you pay license fees to a foreign country, let's analyze the effects a bit better and let's look more into the details. The tax consequences of a cross-border license fees are determined first by limited tax liability rules in the countries where they come from, so in the source country or the country of the payer. Then these rules could be modified or cut back by double taxation treaties, which can be applied. And naturally, you also would have EU law, which could come into play. So if you want to analyze what happens, you will have to have a glance at all these rules and repeat the basics, which you know about these rules. Imagine we have limited tax liability in Germany because a license fee is paid from Germany to a foreign company or a foreign recipient. The foreign recipient will be limited tax liable in case of a juridical person. That will be paragraph 2, number 1 KSTG. Then we have, according to the standard testing scheme for limited tax liability, first to check if the event in question leads to taxable income at all. That's paragraph 49. And indeed, in paragraph 49.1, number 6, you find an entry which says license fees, royalty payments, which are expenses, business expenses for a German permanent establishment of whomever, will be regarded as limited tax liable under German law. In case that the recipient runs a business or is a capital company, the qualification will be a bit different. Then it will be also in the hands of the recipient, treated as business income under 49, number 2, letter F, but that changes nothing in the end. So The next question in case of a limited tax liability is usually the question, how will that tax be collected? Will it be levied by a withholding tax, or will one wait until the foreign taxpayer hands in a tax declaration in the inland? And with license fees and some other events, we have that peculiar rule in paragraph 50a German Income Tax Act of the ESDG that the taxation of such a license fee payment, if it's made to a limited taxpayer, is subjected to a withholding tax, which is 15% of the paid amount. Then the next question is that withholding tax only treated as a prepayment, which will be replaced by the final tax after a tax assessment and a tax declaration, or does the fisc here aim at a simplification for all the people involved and say brutally but clearly the withholding tax is definitive after it has been correctly paid? That event is all over and done with. Nothing else happens anymore. You cannot enter it into a tax declaration anymore. The recipient does not have to pay tax anymore, but also can never claim back the withholding tax. Indeed, that tax is definitive. That is usually stated in paragraph 52 ESDG, and in cases naturally where we deal with corporation tax, the parallel rule is to be found in the Corporation Tax Act, and that will be found in paragraph 32(1), so paragraph 1 or section 1 of paragraph 32, number 2 KSDG. The last question which one should then ask in the standard testing scheme is if there is a withholding tax. Question A, can it be changed into a voluntary or by a voluntary or compulsory tax assessment? So can the definitive character of the withholding tax be replaced by turning it into a prepayment that can be ordered by a special legal rule, which you could find in KSDG or in a double taxation treaty or in EU law? Or can, by another such special rule, the withholding tax remain definitive but can be lowered, let's say from 15% to a far lower amount, 5%, 3%, or what else? Again, such a deviation from the general rule that the withholding tax is 15% and definitive can only be found in a special rule, and that special rule can be in any legal rule or legal text which contains valid provisions, so in Income Tax, Corporation Tax Act, double taxation treaties, or in EU law. So you have to check them all. The first potential conclusion which we can draw here is that under the rules of limited tax liability alone, replacing the corporation tax burden on the side of the paying entity, 15%, by the tax burden for the recipient, 15% withholding tax, is not a very convincing and attractive idea. If I pay 10 million as a business expense, as a license fee, then the German profit of the German corporation goes down by 15%, but the withholding tax then replaces that, although it's then officially paid by the recipient. So you exchange 15% for 15%, not a good bargain. But what we ignored in that first idea is there is still a trade tax in German law. And in trade tax, there is usually another 14 or 15% in play. And now the withholding tax does not take trade tax into account. So The only thing which happens in trade tax is that a bit of the license fee payments is added back and increases the tax base again, but approximately three-quarters can still leave the enterprise without trade tax burden, and that makes, even without a double taxation treaty, that makes the maneuver already attractive. Now, if you have a double taxation treaty, it might be that the double taxation treaty cuts down the withholding tax to a lower rate, or, well, very often, if you look into Article 12 OECD Model Convention, the Article 12 even brutally says that royalties, license fee payments, can only be taxed in the country of the recipient. So that would even entail that the 15% withholding tax, which Germany wants to claim under limited tax liability rules, have to be given back because the German tax is then reduced to zero. You can take it, but you have to refund it then on application. So in the end, the license fees can leave the country with no tax burden at all, and they are only taxed in the country of the recipient. Now that can bring a great advantage financially. Now there is a problem. Naturally, especially with the tax haven countries, you do not conclude a double taxation treaty, or if you do so, you would try to insist in a deviation from the OECD Article 12 and talk about the right to levy a withholding tax on the license fees. So imagine the faraway islands or faraway down where you want to pay your license fee to, has no double taxation treaty with Germany. What to do there? And the answer is a classic thing of tax planning, the so-called stepping stone model or stepping stone approach. If we have the high tax company in Germany and we have the company where the money has to go to in the end, let's say in the country of nearly have no tax, then the two probably have no double taxation treaty. What can we do? No, don't be sad. Just take another company of the group in a high tax country. Let's say they might even have a 50% tax rate, but don't be afraid. Now you conclude a contract where you pay a license fee to that company in the high tax country. So the license fee leaves Germany, 1 million, and as there is a DTT between these two countries where Article 12 applies unmodified, Germany has no right to take any tax at all. Okay, now in the second step, this high tax country pays on a license fee which is nearly as high as the original one to our company in the low tax country. Now, the only thing where we have to look on is that we choose a high tax country in the middle, which also has a double taxation treaty with our final destination country for the royalty, namely with nearly have no tax, so that the license fee can go on from our second high tax country to nearly have no tax, again, untaxed. That's the trick of the stepping stone model. And now imagine Germany, for example, has 90 countries with double taxation treaties, and you can imagine one or two of these double taxation treaty countries will also have good financial relations with the country of nearly have no tax. So that there will be a way how you can kick that license fee first to a high tax country with the DTT and afterwards kick it on from there to the final country where you want it to end up. So yeah, In the end, you will have the local tax on the 950 million, which are kicked to nearly have no tax. Our high tax country will profit a bit by getting a small profit span in the middle. There they take their high tax rate. Congratulations to them. So in the end, you pay here 325,000 in the total. And no, you pay here in the end 25,000 in the middle and 9.5 in the final country. And in the country of origin, Germany, you lower your tax burden by 30% of the amount which was paid, so by 300,000. So that's really highly attractive. So nearly every amount of money cries, please turn me into a license fee and kick me abroad. I want to end up in a low tax country. So naturally, you see, well, there was no reason to be sad. You can smile and be happy. The problem is, how can you establish such a stepping stone model? Well, imagine you have again your German company, you have your low tax company. So first, your German company, if they developed a patent right, they sell the worldwide rights. Now our low tax company sells a license or gives a license for the European market or another region of the world to our company in the middle. And our company in the middle then begins to grant licenses to the German company, the English company, the French company, and so on. So they sell a regional under license. And now you have that constellation where license payments can flow as you want it from Germany to the middle country, from there onwards to the low tax country, and then happiness can no longer be prevented. So that is how such a stepping stone model would function. And the stepping stone technique, ladies and gentlemen, don't misunderstand that, works in many, many circumstances, not only with license fees. It's just a general, always useful approach where the direct way is blocked. Oh, good. There is also a small set of EU rules on the taxation of license payments that is contained in the Interest and Royalty Directive of the EU from 2003, and that also can be very useful. The directive says interest, okay, not our subject at the moment, but in the last chapter, interest arising in a member state of the EU shall remain free of any tax in the country of origin. So the recipient will neither be taxed with withholding tax nor by tax declaration and assessment. So the interest is not taxed by limited tax liability. And the interest will only be taxed in the country of the recipient. That's a good parallel to Article, please, there is a typing error, Article 11 OECD Model Convention. Now, with a license fee, the same applies. The rule for interest and license payments is only valid under that directive for payments made by a company of a member state or a PE of such a company in a member state to a company or a PE of a company in another member state. And the two companies must be closely related, associated companies. That means they have to be first companies in a legal form, which must be on a closed list in the annex to the directive, and the companies must be connected by 25% participations. In accordance with general principles of tax law, however, Interest and license fees are only treated as such if they do not contain, or as far as they do not contain, hidden profit distribution, because a hidden profit distribution is not interest and is not license fee payment. It just pretends to be a part of an interest or license fee payment, and so it is split off and taxed as it should be, so it will be regarded as a dividend payment. Well, the last and most important rule for practice probably in that directive is that the application of the directive can be denied by a member state in cases of tax abuse or where tax evasion, tax avoidance or so is the principal motive for the transaction. That could hit our cases here, but the problem is naturally if such a rule can apply is a matter which has to be decided by the European Court of Justice. They are far more reluctant to acknowledge the existence of abuse than the national courts. So what we must keep in mind naturally is that the Interest and Royalty Directive defines associated enterprises only as such which are connected by a 25% participation, and they only acknowledge a core group. So payments between a parent and a direct immediate subsidiary can qualify, and payments between two subsidiaries of the same parent can qualify, so sister company, but not parent and second tier subsidiary, so grandchild or grandparent company, that doesn't qualify. They must be combined by direct 25% participations. You should further know that the rules of the Interest and Royalty Directive only apply to the member states of the EU, not to the EEA. Although payments to an EEA state may not be discriminated, so indirectly it can be extended to payments to these countries. And additionally, one should know that in a tax-related agreement between the EU and Switzerland in connection with the automatic exchange of information on private savings account in Switzerland, one has guaranteed that the rules of the Interest and Royalty Directive and of the Parent Subsidiary Directive also apply to companies in Switzerland. So for us, it would be interesting that payments between, let's say, a Swiss parent company and a German subsidiary automatically qualify for the application of that Interest and Royalty Directive provisions, because identical provisions have been laid down in that treaty with Switzerland. Well, why does this have a role for tax planning constructions? The answer is, if you apply a double taxation treaty, most member states reserve the right, and they do it successfully often, to override tax rules which they don't like just by a treaty override, and they usually rely on that the other state is not going to complain too heavily if the fight is against the tax saving model. Now, in case of European Union law, it's not possible under the EU constitutional framework that a member state overrides EU law. It's absolutely impossible. No judge, no authority, no citizen can overrule EU law in any of the member states. So if you don't only have a double taxation treaty, but the Interest and Royalty Directive as a legal basis for not paying withholding tax or similar amounts on a license payment, then your legal position is far stronger than in other circumstances. Okay. That the payment only applies to payments to related companies within the EU is not really an obstacle, because if you want to end the payment up somewhere in nearly half no tax or so, which is not an EU state, you use a stepping stone model again. You have more than 25 other member states at the moment, 27 in total. So if you are in one of them, let's say Germany, you can select between 26 other member states where you establish a sister or subsidiary company to which you pay a license payment, and it then passes on the money according to the stepping stone ideas to that other company somewhere else. In principle, that could work. You could only regard that as an abusive construction, but that's sometimes difficult to prove. So, nice idea. You see, on the other hand, how easy that is to lower the tax base by such constructions and to let the money end up in a very low tax country. And so, naturally, we can draw the conclusion again that fiscal ministers and states will not be willing to tolerate that. So we have to ask, what can they do against it? The answer is the tax saving effect works in the same way as interest payments with the interest tax saving model. The tax saving advantage comes from the deductibility of the payment as a business expense. So countermeasures can basically use the same theoretical options as in the case of interest payments. You could treat license payments in the same way as dividend payments. That's technically rather difficult, because here the recipient does not need to have shares and so on. It will probably confuse people greatly. So the alternative would be to go the second way again, just to say license payments, are license payments, but they are not deductible under our tax law. That is again easy, simple, uncomplicated. It requires the consent of no other state, because you remember the double taxation treaties just say you can tax the profit of a business, and how you compute your tax base is entirely your own decision. So if you say something is a business expense or not, that's a question of your legal decisions. If you say it's a business expense and is deductible, or if you say it's a business expense but not deductible, all that is completely left to you. So here you can be free to choose your decision, and that is naturally what people do. So probably the best approach for states to counter that license fee-based tax saving model is just cancel the deductibility of license fees. Now, we can conclude that the temptation will be high to establish a license fee barrier. But the practical problem is then again, there will be cases where license fees or royalties are really necessary, where they are really caused by business motives and don't serve a tax planning purpose. So what are we going to do? You will have to define which royalty payments you are still willing to accept as genuine, as unsuspicious and justified. And again, here we end up in an area where each state can decide according to its own preferences. Here you can't expect them to have all the same outcome or decision, because what you are willing to tolerate, until which limit you are willing to risk tax saving models to be successful, that is your own very personal decision. And that's very arbitrary. So you can expect different solutions with regard to that point. A basic common trait of all anti-tax saving measures here will be non-deductibility of license fee payments, but in how far, that is the question. Good. The current situation knows a license barrier rule in German law in paragraph 4J. Current is 2021 because that's the moment when I register this video. And that 4J applies only to license payments from the inland to a closely related person. So the idea is to outsiders, it's always believed that there is a genuine reason. Although you have to answer the question if that outsider passes on the license fee or parts of it to a company of your own group again. So a stepping stone model where you first pay to an outsider and that outsider hands on the money to a company of your own group again would also be covered by 4J. Then the license fee barrier rule only applies if the license fee in the final destination ends up with a tax burden of less than 25% in the hands of the recipient. So a stepping stone model where first you pay to a 50% country and then the money is passed on and ends up in a low tax country would also qualify. But additionally, that tax burden is not enough. It's additionally required that the license fee is lowly taxed due to a preferential treatment in the country where the license fee ends up. So it's not enough to have only 10% corporation tax to be paid. That 10% must be a deviation from the general rules in that country. So 4J, the German license barrier rule, only aims at preferential treatment, so only aims at cases where a state established explicitly exceptional, favorable, especially favorable rules, especially for license fees. So if you have a local general tax rate of 10%, that's less than 25, but not a preferential treatment, so everything's fine, you can fully deduct that license payment. Only if a state makes things like our general rule is 30%, but for license fees we only take 3%, that would be something where the license barrier rule is activated. So it does not really aim at minimizing the fiscal losses. It more aims at rendering models of other states less attractive or even unattractive, where another state says, I keep my general tax rate high, but I want to take part in that nice competition in the world market that we want to obtain tax revenue by operations on papers with patent rights and so. And now for this, our general tax rate is too high, so we offer just for license fee revenues a lower tax rate, and that is regarded as unfair, and that is where 4J aims at. Now, if 4J is applied, it gets complicated because the license fee is not banned totally from deductibility, but only a certain part is banned from deductibility. And the idea is there is a formula set up which in principle leads to a tax burden in Germany, which then compensates the lower tax burden abroad relatively exactly. So imagine you have in the country where the license fee goes to a preferential tax rate of 5%, and Germany expects a minimum tax burden of 25%. Then the Germans say, well, the gap between the adequate and the actual tax rate is 20%. 20% out of 25 means approximately 80%. If you split it up mathematically, you could say 80% of the license barrier of the license fee is not adequately taxed, and 20% would be adequately taxed with the 25%. So they just say, okay, then we ban the deductibility of 80% of the license payment. Or if the foreign tax is 10%, then the non-deductible amount will be the difference between 25 and 10 is 15. So 15 out of adequate 25 means 60% of an adequate tax burden is missing from the German perspective. So 60% of the license fee payment is declared non-deductible. And last but not least, if the foreign tax treatment is non-preferential and the tax in the country of the recipient is only 10%, then the non-deductible amount will be 0 because, well, 4J only applies in cases where something is a preferential treatment. So in the last consequence, what does that mean concerning the license barrier rule? Well, you could say nice idea, but it's really rarely applicable because, yeah, shifting profits to a 20% country with a preferential rule triggers 4J, but shifting profits to a country where the general rate is only 3% on everything is not a preferential treatment, so you can do it without fearing any harm. So if you are not completely mad, then you will just shift it to such countries. So you will avoid preferential regime countries and just pay license fees to countries without a preferential regime. So that means below the line, in the present version, 4J is not a thing which has a very high practical importance. Nevertheless, in theory, it's an interesting development that things like that already come up. And naturally, one never knows what is going to develop in the future, so one should know about the basic approach. And it's clear what's going to come next at the end of this chapter, a training case. But this will be reserved for the next video, naturally, and so this shall be the end of this small video. I thank you for watching and hope to see you soon back on the channel again for the next part of this lecture. Thanks and goodbye.